HowExpert! Top 10 tips and lessons from the essays of Warren Buffett. Number 1. Purchase quality businesses at reasonable prices. A common pitfall of modern investing is seeking growth stocks that are incredibly cheap and hoping for them to explode in value. However, billionaire investor Warren Buffett disagrees with this approach fundamentally. The truth is that while many of us might treat the stock market as a shopping mall, we have to remember that we're still investing in a business. Therefore, a quality business with good fundamentals is orders of magnitude more valuable to an investment portfolio than a mediocre business, even if that mediocre business seems to be a better deal comparatively. Number 2. Evaluate the leadership of a business to gauge its quality. While Buffett personally invests in quality businesses, it may be difficult to analyze which businesses are high quality and which are not. Buffett, when explaining his moves in the market, often uses the leadership of a company as justification for a high investment. The truth is, there are too many ways an executive can ruin a stock for an investor and end up seeing no financial repercussions for it. Therefore, executives need to act like they have a personal stake in the company they run, even if they technically aren't the owners. When the CEO has personal stock in their company, when the accounting of the firm is robust, and when dividend yields are high, you'll know you've found an exceptional business. His company Berkshire Hathaway currently has over $150 billion invested in Apple, a corporation famous for its intelligent executives. Number 3. Understand a company's assets. Throughout his essays, Buffett repeatedly hammers home the point that stocks are not a lottery ticket, but partial ownership of a company. While this may seem basic, most investors often forget this crucial fact while picking potential stock options. When choosing a stock, find stocks that have tangible assets that can produce profits. Several of Buffett's current investments are in companies that rank among the highest asset holders in the world, including Apple and Chevron. Number 4. High returns attract competition. Imagine for a second that the price of ice cream skyrocketed, and every scoop would net a return of $100. Would you immediately start selling ice cream? Probably. It would be insanely profitable for a short while. But the problem is that eventually, everyone else would start selling their own ice cream too, and the price of the dessert would go back down to its current, normal level. Warren Buffett argues that the same is true for companies. If one company finds a highly profitable niche, it won't be long before other corporations begin to copy that niche until it is no longer as profitable. As a stockholder, this means your investment is going to be worth less. Buffett advises finding companies where there is a high barrier to entry in their market. In the United States, it's unlikely that another company could start making phones that are as popular as Apple's, which might help explain Buffett's huge gamble on Apple with his multi-billion-dollar investment. Number 5. A good business isn't always a good purchase. Though Warren Buffett hammers home the point about investing in quality businesses with high assets, that doesn't mean that just because a business is of good quality that it is worth investing in. A solid business may still be overpriced, in which case an investor may still lose money on the stock. Number 6. Don't be afraid to get volatile. The volatility of a stock is how often the stock changes. Conventional wisdom suggests that a volatile stock is a bad investment because it is riskier. Warren Buffett spends a large part of his essays, as well as his speeches outside of this book, hammering one key point. Short-term fluctuations in the market mean absolutely nothing. If anything, volatility gives you the opportunity to purchase a good company for a great price due to random chance. He recommends you disregard volatility as a factor while picking a stock option and take advantage of volatility when purchasing one. Number 7. Use fear to your advantage. Amid a recession, it becomes easy to fall in with the crowd and panic and sell all of the stocks in your portfolio to minimize losses. Yet Buffett and many investors subscribe to a different philosophy, one that encourages greed during times of fear. While others are panicking, take advantage of the opportunity to buy stock in wonderful companies at a bargain price. When the stock market is crashing, the entire store is on sale. The time to buy is when everyone is selling, and the time to sell is when everyone is buying. Remember, you only lose money once you sell the stock. If you wait long enough and have invested in a quality company, you'll likely be back in the green soon enough. Number 8. Invest for the long term, not the short term. One of the most striking aspects of Buffett's letters is how, despite being the greatest investor of all time, he tends to hold on to stocks for years after purchasing them. In investing culture today, it's trendy to buy and sell stocks on a monthly, weekly, or even daily basis in the case of day traders. Buffett has compared these short-term investments as akin to gambling, since there is no rhyme or reason to the price fluctuations of a single company in only a day or week. Sure, some people might be able to gain money quickly by selling stocks quickly, but those people are just as likely to lose that money even quicker. The only way to expect consistent growth is to hold on and not get greedy or fearful. Weather the storms of recessions, and you'll come out the other end richer than most. Number 9. Diversification is for the know-nothing investor. For Buffett, his argument has always been against diversification if you are an investor who understands how to research companies. Diversification, he argues, is basically hedging your bets in order to avoid risk. For investors who are beginners, or don't have the time to research the companies they want to invest in thoroughly, diversification is most certainly the way to go. In other media, Buffett has recommended investing in index funds that are incredibly diversified and will likely net a consistent return. However, for investors who claim to invest based on research, diversification is a red flag that they aren't confident in their choices. There's no reason, Buffett says, that an investor has the time to research 30 to 40 different companies thoroughly. If you're scared of risk, invest in diverse index funds. But if you're going to analyze individual stocks, pick around 5 to 10 and stick with them. Number 10. Human nature is timeless. While Buffett's essays are now decades old, the information within is still valuable for one simple reason. Human nature never changes. Even back in the 80s, people were panic selling their stocks at the first sign of trouble, investing in cheap businesses as if they were lottery tickets, feared volatility, and had portfolios containing the stocks of dozens of companies. Human beings are built to be afraid when money is involved. Buffett emphasizes one thing through everything he writes. Don't succumb to your nature. Take advantage of other people's natures. What the crowd does is irrelevant to your personal opinion. If you have solid fundamentals, are intelligent while analyzing companies, and invest accordingly, you will end up more successful than those who follow trendy stocks and invest in the latest cryptocurrency or NFT.